Today I'd like to speak to you about Merchants Trust and some of my favourite subjects, which are in particular dividends. And we'll talk about the importance of dividends to the stock market. Russ has given some brilliant background to that, but I'm going to give you a bit more information about that. I'm then going to talk about how we've managed to deliver strong performance as well as having a high dividend yield. And then I'll look at the current market opportunity and some of the themes that we are investing in at the Merchants Trust. But before I do, I'll just start with a bit of background on the Merchants Trust. Merchants Trust was established in 1889 as an investment company and currently invests in a portfolio predominantly of large, high-yielding UK equities. And we think the UK stock market's a great place to invest because we have some of the best standards of corporate governance in the world, but we have exposure to companies and industries businesses around the world that are listed in the UK stock market. The Merchants Trust has a dividend yield of around about 5%, and it's an AIC, Association of Investment Company Dividend Heroes. The company has raised its dividend every year for 39 years, and we have significant reserves, which I'll show you in a minute. We have a strong performance record driven by an active, high conviction investment approach, which has a value-driven philosophy, which means that we pay a lot of attention to the price we pay for companies when we buy them. And the third thing to say is that we have one of the lowest management fees in our sector, 0.35% of the gross assets, and an experienced board of directors who represent shareholders, and that comprises people with both financial market experience, but also commercial experience in the real world. If we move on to dividends, I think dividends don't get the full attention they deserve, and I think Russ gave a really good explanation earlier, but they make a really important contribution to market returns. Now, in the 20th century, in the last few years of the 20th century, we saw very strong market returns, and dividends only made up the minority of the return if you look at the 5 years, say from 1980 to 1985 or other periods. But in this century, so far, dividends have made up the majority of returns from the UK stock market. And in fact, in every 5-year period up until the end of last year, dividends made up more than half of the return. And not only do dividends give you a strong return or a strong part of the return, they have a consistency element to them. They're always giving you a positive return, even when the years when dividends are cut, the return you get from dividends is positive. Whereas clearly the returns from capital returns on stock markets can go up and down, and sometimes quite violently, as we saw last year. So dividends are important. And just to go one step further than that, and I apologize to anyone who's seen this chart before, because I have used it a number of times, but there's a really interesting feature about dividends. If you put £1 in the stock market back in 1900 and you bought the 100 biggest companies in the UK, your pound would have grown to about £37,000 over the subsequent 119 years. But if you bought at the beginning of 1900, if you bought the 50 shares with the highest dividend yield rather than the whole 100, and each year you sold those shares and buy the next shares with the highest dividend yield at the beginning of the following year, your pound would have grown to £161,000 with all the dividends reinvested. So you could have made a significantly higher return simply by buying the highest yielding shares. And we can spend a lot of time talking about why that is. I think the main reason is there's an element of value investing. Companies, when share prices fall, dividend yields go up. And so when you're buying companies with high yields, you're often buying companies that have come back in price, which are often a bit out of favor and cheaper. And sometimes they recover and you get a good extra return. But also dividends provide a really important discipline for management of company, because companies have to be very careful with their cash if they're paying dividends. And it provides a strong capital discipline, financial discipline on the way those companies allocate capital. Having said all that, companies with a high yield can be dangerous. They can be value traps. They could be companies that are paying a high yield because there's a big risk in the future that dividend might not be sustainable, and investors are demanding a high yield because of that risk. So you have to be really careful with high yielding companies, but they're not value traps. The way we approach it is we look to buy companies with a yield in line with the market or above, either today or within 18 months future. Not that companies doesn't have to have a high yield today, but the yield never drives our investment decision. We're always looking to buy a company where we think we can make money. We're looking for the total return we can generate. So the yield isn't sufficient for that. And equally, when a share starts to perform well and the dividend yield drops below the market, say, there's no automatic sell if a company yield drops below the market. following this process, we've been able to deliver a rising dividend yield, rising dividends for 39 years, as I said earlier. One of the great features about investment trusts is the directors are able to put money away in good years into reserves and draw on those reserves in more difficult years. And you can see on the page in front of you how this works. So last year, as Ross said, it was a very difficult year for income. We had a significant cut in earnings. The earnings of the company fell by about 29%, and we had to draw on reserves. We had to draw about just under 10 pence from the reserves to keep paying a growing dividend last year. But in other years, the directors have put money away into reserves. You can see the green bars here. And we still had 18 pence of reserves at the end of the year. As Russ said earlier, you're seeing an improving trend now. Dividends are recovering very quickly, which is helpful. And the board made this statement in April with the annual results. The board recognises the importance of a growing dividend to shareholders. We can see a path to a covered dividend in the medium term. Absent any significant further deterioration in the outlook for income, the board plans to continue with its progressive dividend policy and is willing to consider utilising reserves built up over many years to cover any shortfall from earnings. So you can see the important role that reserves are playing in that. So with our high dividend approach, we have been able to deliver a strong return for shareholders. And similar to the chart that Phil showed you earlier, the green line on the top chart here is the shareholder total return that we delivered at Merchants Trust over the last decade. The black, or the very dark line, is the net asset value total return, which is very similar to the shareholder total return. And then the blue line is the benchmark return. And we have achieved significant performance above the benchmark over that period. But as you can see last year, if you look to the right-hand side of this chart, we had a very volatile year. In the first half of the year, the market fell sharply and our performance underperformed significantly. And then we saw a very strong recovery in the second half. The Merchants Trust performance is influenced by gearing. We have about 15% gearing in the trust. So that amplifies returns, both in good markets and negative markets. So it's important to understand below that what we're doing at the portfolio level. And we show that in the table underneath. The last 12 months has been exceptional, but even if you look over 3, 5, and 10 years, we've delivered returns significantly ahead of the benchmark at the portfolio level, between 1.5% and 2.5% per annum ahead, which is a significant level of outperformance from our strategy of buying attractive, high-yielding companies. And it's been actually, to be fair, quite a difficult environment for income investing in the last 2 or 3 years, particularly. So this has not been an easy task. And I'll come back to that, how we do that in a minute. I wanted to say a little bit about ESG. Russ raised the subject of environmental, social, and governance, which is a very hot issue at the moment, and investors. And just want to set the scene of what we do and how we think about it. We think about these risks in our portfolios, we integrate them. But we're not following what some people call a social responsible investment approach, SRI, where you exclude certain sectors. We don't do that. We weigh up the risk, we weigh out the impact of issues about the environment, social policy, governance in companies, and we form our own judgment about any significant risks. And we take those into account. And sometimes we will not buy a company because of those risks, but other times if we think it's fully discounted in the price, we may still invest. And then we'll engage with the businesses to try and improve what they're doing. And I'm a firm believer in engagement. I think if you take the issue of, say, delivering hydrogen to the economy and delivering hydrogen to trucks around the country, the only companies that really credibly could do that on a 10 or 15-year view at scale are probably today's energy companies, which can handle massive investment programs, transporting hydrocarbons or transporting gases around the country and then delivering it to trucks at what are now petrol stations but might become hydrogen filling stations. So I think there's an important part for traditional energy companies to play in the energy transition. That's the way we approach it. Turning now to the current outlook and how we're setting up the portfolio. The UK is really interesting. It's one of the only areas where we find value at the moment. And Russ gave an excellent explanation of how expensive bond yields or government bonds look, and both sovereign bonds and corporate bonds look quite expensive to us around the world. And in fact, even most equity markets look pretty pricey now compared to history. But the UK is the one area that stands out as being reasonably valued or slightly better than reasonably valued compared to history. And just for interest, I haven't put this chart together. as a UK equity specialist, this has been done by our economics and strategy team, and they're not even based in the UK, so there's no home bias in this chart. They're pretty objective in the way they analyze it. Beyond that, when you look at the UK, you find an economy that's gradually opening up. We are having quite a successful vaccine rollout program, and therefore the UK economy is likely to recover a bit quicker than EU, only a few months, but slightly quicker than other places in the world. And that's despite that if you couple that with the valuation, makes the UK look quite interesting. And if you look at the UK valuation compared to Europe on this chart, you can see how we are at a multi-decade low level of valuations of the UK versus Europe. And the UK has got cheaper and cheaper ever since the Brexit referendum in 2016. And so there really is a great opportunity in UK shares compared to other European shares and to other global shares. But having said that, life's not going to be the same coming out of the pandemic. Many industries have changed. We're getting used to doing things digitally, like me speaking to you tonight, in a way that would have been unthinkable 2 years ago. And there'll be changes in many industries. So we have to accept that the new normal is not going to be like the past. We have to think about how things will be in the future. But when we can find, and the markets are starting to look through into recovery, and many shares have recovered significantly. Many companies have doubled in the last year or so. But there are still pockets of opportunity. There are still many shares that offer good value within that context of a market that's starting to re-rate. One thing that's really interesting about the UK stock market is how polarized it is. And I apologize for this chart, it's quite complicated. But what we're showing here is we're breaking down the stock market into buckets of different type of companies. So on the right-hand side, we looked at all the companies in the stock market in red, where the price earnings ratio, how much you pay for a pound of profits, is over 24. So you're paying 24 pounds for every pound of profits. And there's almost 20% of the stock market at that level. In fact, there's quite a lot of the stock market, about 30 or 40%, on a price earnings ratio of over 18, which is quite a high level. And at the same time, on the other end, there's a fair number of companies with a price earnings ratio below 10. There's 15% of the stock market. So we have this polarized market. There's very little in the middle, which is quite unusual. And investors are paying up for quality, for growth, and they're neglecting whole pockets of the market where valuations are actually quite reasonable. If you contrast that with our portfolio, which is the blue bars, we've got most of the portfolio in the much more modestly priced area and very little in the highly rated area. The average price earnings ratio on our portfolio is 11.6 compared to over 14 in the market. Now, when we show this chart to people think maybe we're buying low quality businesses, we're buying rubbish businesses with challenges. But we would argue very strongly we're not doing that. In fact, our whole investment process is about trying to understand and identify decent quality, sound quality companies with strong fundamentals, but those that are trading at sensible or attractive valuations and which have supportive underlying themes. And Phil talked about some of the structural themes. We're looking for the same types of things, but some of the themes we look at might be more cyclical. So just to pick out one or two of those, one area where we're seeing strong spending growth at the moment is on repair, maintenance, improvement, and housing. People are spending more time in their homes. They might be finding their sofas uncomfortable, or they need to get the windows fixed. And you're seeing spending on the home environment picking up. And yet many of the companies in that area are trading at modest valuations. And we weren't seeing a boom before the pandemic. In fact, we saw very subdued spending on this whole area for 4 or 5 years. So we do see strong spending to continue in this area, probably. And yet we can find companies with really attractive valuations. So that's an interesting area we're looking at. Another area is the whole area of digital winners. Now, clearly some internet stocks are on really high valuations, but there are others on much more sensible prices. A company like Next, which is a retailer, obviously owns many stores around the country, actually makes the vast majority of its profits today from its online retail operation, as well as the credit that they charge the customers in the online side as well. And that business is growing rapidly. It's growing in the UK, it's growing internationally, and it's growing. They're also developing a business to set up other brands' infrastructure and to sell those other brands online as well. So that's an interesting business that's benefiting from digital trends. And the third area I'll highlight is where we see improving mix. Businesses don't like being called value investments, don't like being seen as challenged companies. And if you've got a business that's got many parts, they'll often invest in the good part of the business to transform it to being a better business. And Tate & Lyle is an interesting example which is a company that owns a processor of corn in America, which makes high fructose corn syrup, which is a bit of commodity, but also they make specialty ingredients to improve food properties, to take out calories, to take out fats, to take out salt and replace it with natural fibers, which can help health benefits. That part of the business is growing faster, makes higher returns, and is much more valuable. The company have recently announced that they're looking at selling a majority part of their primary product, their commodity business, effectively, and that would significantly improve the quality of the business. So where you see these transformations coming through, you can see companies not only improving their own business, but they can get a much higher rating, a much higher valuation in the future from doing that. So that's just one example of a type of company that's going through a transformation where I think the market might value it much more highly in the future. So just to conclude, I'm just meeting my time, which is great. Dividends are a really important part of long-term returns for investors. In fact, they've been the majority of returns for a passive fund in the UK market for the last 20 years. The Merchants Trust has a high dividend yield, and we have grown the dividend every year for 39 years, and that remains a really important objective for the Trust. We have delivered strong returns from an actively managed and value-orientated portfolio, despite actually quite a difficult environment for value investing for the last few years. And finally, the UK stock market, I think, is really attractive at the moment. It's one of the cheapest markets in the world, and there are some great stock picking opportunities, and we're very excited about that.